in this video, we're going to record our purchase of common shares as a fair value through net income investment. So there's actually three ways to record these passive investments. One would be through fair value through net income. If you're a publicly traded company, you have to follow IFRS, and in that case you have another alternative, which is fair value through OCI. And if you follow ASPE, you can just keep it at cost. So this one is fair value through net income, which is both ASPE and IFRS. So I thought I'd just show this using a T account for my actual investment. And just for simplicity, we're just going to track one investment instead of a bunch at a time. And it's more common to have a bunch of different investments in one of your portfolios. Okay, so let's read this question. Abdul Corporation purchased 400 common shares of Sigma Inc. for trading purposes for $13,200 on September 8th and accounted for the investment as fair value through net income. In December, Sigma declared and paid a cash dividend of $1.75 per share. At year-end, December 31st, Sigma shares were selling for $35.50. In late January, Abdul sold the Sigma shares for $34.95. So there's quite a few journal entries that we'll have to do through this life cycle of us buying the shares and then selling them. So the first would be to put the shares on our books. So it says that the shares were $13,200, and I'll just highlight that just right there. But it was 400 shares that I bought. So right beside here, I just kind of like to see how many shares I own and then the price per share. So the price is $33 per share is what I purchased them at. Now, when you buy and sell a bunch of different shares, we actually use the weighted average cost of the share. But in this case, it's just these ones that we're buying. We're not buying any more for a different price. So the $33 is the cost. So to put this on my books, I'll do my journal entry for September 8th. I'll debit my fair value through net income investments for the $13,200. And then I'll credit my cash for $13,200. And I'll just say to record purchase of shares. So we are purchasing somebody else's shares, and this is our asset. Okay, so the next step is to record the dividend. So a perk of buying another corporation's shares is that they pay also dividend income. And the way that we deal with dividend income under both the fair value through net income, the cost, and the fair value through OCI method is just to record it as dividend income. So I'll record cash and then credit to dividend revenue. And this was sometime in December. So I'll just say December. Now the dividend that I receive is $1.75. So I'll do $1.75 times by my 400 shares because that's how many shares I own. So I get a dividend for a dividend check of $700. And this is a bit easier in real life because the dividend check will just come in, or it'll just come into your trading account as the $700. So this was $1.75 per share. So I'll just say to record receipt of dividends. So that just goes straight through the income statement. Now, when we're using the fair value through net income and the fair value through OCI, what we need to do is revalue the investment to the fair value. So it says that at the end of December 31st, Sigma is selling its shares for $35.50. So we're not selling these shares, we're just bumping up this share price on our books to $35.50. So I'm just going to calculate the balance first. So if I take 400 times $35.50, that gives me $14,200. That's my new balance. So I'll have to do a journal entry for the difference. So the journal entry is 1,000. So I'll record on December 31st. I'm going to debit fair value through net income investment. And we could also credit it this if I had to bump down the investment. So we write it up and down to the fair value at year end. So I'll record the 1,000 and then credit. We just call this an unrealized gain or loss. So we don't actually record it as a realized gain or loss until we sell it. So it's just sitting on our books at $14,200. So now in late January, it says that we sold the Sigma shares for $34.95. Let's see here. I'm going to do this in 2 steps. So it really just is a bookkeeping thing. You could actually just remove whatever you last reported in your investment account out and then record the difference as your realized gain or loss. Or what we can do is bump up the investment to the share price and then we can derecognize it. So I just want to be consistent when I do it. So I'm going to do it that way. I'm first going to bump up. So I'm just going to revalue this share. So if I'm selling them for $34.95, see here, 400 times $34.95. So in this case, I'm going to decrease this account by the difference. So I'll debit my unrealized gain or loss and then credit my fair value through net income investment. And this one's pretty easy because I know that the debits and credits. So this one's a debit and this one's a credit. So once you do that, then the opposite side is either going to be your loss or gain. So I'll just say to adjust investment to fair value before sale. And now what I can do is get rid of this. So I will have to credit my investment account. For the $13,980. And then debit my cash for the $13,980. And I'll just say to record sale of investment. So again, I've sometimes seen these 2 journal entries put together. So sometimes they would do debit cash for $13,980, debit unrealized gain or loss for $220, and then do a credit for fair value net income investments for, I guess, the $14,200. But you just want to be consistent with the way that we handle them. So I'm just going to keep handling it this way.